section that was at 9:50 p.m. and then go back and move up to that timeline. Okay? Yeah. I think everyone's agreeing that I can just get through the slides and flow the recordings, and then you go back. Okay, sorry. All right. This is exactly what I'm talking about. You have the Asian range, right? R equals range, 51.4 pips. The ideal Asian range is 50 pips or less. The 50 pips or less allows you to see the stop hunts clearly. The stop hunts come in 25 to 50 pips below the box and above the box. Ah, now it makes sense what this is. Here's the 25 marker. Here's the 50 marker. The shadow box highlights the Brinks trade setups. Is it always going to fire in the Brinks trade box? No. You have to have a deeper understanding of what's going on. Okay, so let's walk through this chart. You have consolidation, right? You have a pin to the low right here. Maybe they picked up some pendings. I don't know what happened here, but here's what goes on. Towards the end of the session, before the start, they shifted the zone away from higher level holders in here. But they stayed in consolidation. You see that? Your job is to be smarter than a piece of blue ribbon that paints on a chart. Your job is to reevaluate or reconsolidate the zone and realize they have not made a very aggressive move yet. When you reevaluate the consolidation, you then have your 3 vector pushes with a nice hammer to the low. Notice how they went past the blue tracer into the stop hunt zone. They even spiked through it. But they issued a hammer right here. Just outside. That was bad. Just outside the shadow box. Session beginning. The timings were off by a few bars. Big deal. You know better. They quickly pull back. Go into consolidation to collect positions. Validate the short orders. Okay? Now, notice something crazy. This candle comes all the way back to the low of the day, just enough to pick up anybody that was in here, anybody that got it in here, and that was right. Because of the size of this candle, this would be a pass entry for our group. Because they shifted the zone. If you didn't get your entry in here, when they shift the zone, it's too late. I don't want you chasing it. Why? Think about the size of your stop loss. The appropriate stop loss goes below the low of the day. But Steve, it runs perfect. Of course it did. You could see it in hindsight. Of course it did. But how do you know they're not going to come back for another pass? You don't know that. The stop loss goes where it goes. I can't help it. I'm going to talk about it. Jose doesn't know me. He asked where I got in. Jose, I got in right there, buddy. I know people are saying thought so. I'm kidding, man. I wish I was that good. All right, look. Because of the size of the shift of the zone, that's a note, that's a pass. But if you saw the hammer issue just outside the shadow box in the stop hunt region, you could have taken the trade anywhere in here. Stop loss goes below the low. That is a granny entry. Okay, now, the low should hold for 30 to 90 minutes. It's safe to enter. If you have all the other elements in line, they issue a hammer just outside the shadow in the stop hunt zone. It happens to be laying on the 4-hour timeline, which is the blueberry. We'll talk about it. They hit their 3 vector candles on a reconsolidation of the zone. Right? You extended the blue box. You know better, man. That's consolidation. There's 3 vectors to the low. Vector candles to the low. They ended on a hammer, pulled back. This is an outside bar. I don't care if it has a pin. I don't care where it closes. This bar is an outside. Man, I'm so close to the edge, I keep changing the slide. I'm very sorry. This slide right here, this is an outside bar. How could that be an outside bar? Because it forms the low of the day, and the consolidation is off of it. It's inside. The consolidation is inside the low of the day formation. That's an outside bar. Okay? When market makers trade inside this spike to the low bar, that's a clue for you that the low is forming. Because the spike here forms the low of the day. The consolidation validates that you are at the LOD. The fact that they spiked past the light blue tracer validates you're at the LOD. The fact that they spiked the 4-hour EMA validates you're at the low of the day. The fact that you're in the shadow box and they spiked past the shadow box and came back validates you're at the LOD. Those are the clues to the puzzle you got to put together. We like to wait for the second pass, but you got a lot of opportunity in here. This candle comes back to bust your chops a little bit, may or may not get you. Not a big deal. Don't worry about it. There'll be another setup just like it tomorrow, I promise, and that candle won't be so big. Okay? See it? Alright. It's 10. Let's take a 5-minute break. We're going to go into the count, and we will end here tonight after this lesson. The count discusses the levels. Alright, so let me get my little 7-minute stopwatch up. Someone asked where I got that from. It's like stopwatch.com or something. It's www.online-stopwatch.com. Okay, everybody back? Good? Alright, hear me? All that stuff? Alright, some of you are asking about the stuff on the charts. Robert, you're not the only one. Don't worry about that stuff right now. I'm going to break it all down for you. What I want to do is I want to strip away the concepts that you have about the market right now, and I want you to look at the big picture of what these guys are up to. Don't worry about a box, a shadow. I'm going to cover all that shit. It's on there. I know it's in my charts because that's the templates that I took the pictures off of. Just open your mind to what's going on. Okay? And I'm going to tell you what the box is, what the arrows are, what the average. I'm going to tell you all that stuff. Just right now, I want you to grasp the concept, okay? Alright, so let's get going. I didn't see any questions other than that I need to address right now. We'll take some questions at the end when I give you your homework. Okay. The count. The third most important element of the system is the levels, or the count, to know where you are in the cycle. Right? You need to walk up to a chart and go, okay, midweek reversal, W's anchored in, second session, W, V, V, M, Wednesday, Thursday, Friday, reverse. That's why you don't need to spend days and hours doing technical analysis. When you become proficient and can identify the midweek reversal or the peak formation anchor points of the cycle, you'll be quickly able to identify the technicals on the market maker side of the market. Not on the, where the average crossed over, what part of the cycle am I at, is that support and resistance from October 1905, will that hold? Understand? I said this in my presentation on the sales side of the business, that you don't got to spend hours and hours trying to analyze the technicals. You analyze a chart over 3 to 5 days, identify the anchor point, start of the cycle, and you know what to expect on every pair at any given time. Because the market makers have their own cycle and their own way of handling things. You now know how to handle that. Or you're getting there, or I'm getting you there. We'll figure it out, okay? All right. The cycle, as I said earlier, is based on trader psychology. Really, it's based on human psychology. Fear, greed, and inexperience are used to prey upon the traders. The newbies that don't know anything, fear that you're missing the move, greed that you're going to maximize your gain. Those are the emotions that everybody feels in this business. As I drew the pattern for you earlier, there are intraday counts and counts over several days, the weekly cycle. They are all there to trap the traders and grab your hard-earned equity. I've seen people write this a couple of times to me in chat. Oh, Elliott wave, blah, blah, blah. No. Do not associate this with Elliott wave or any other indicator. Market makers form zones or levels to trap the traders, book their profits, and hit the stops. Sometimes it's like a joke. You can see it like stairs. It's so easy. Sometimes it's not so easy. Understand that at level 1 and level 3, the aggressive moves are seen. Why? They just made a huge run. They snagged the traders. Some amount of money is stuck. They want to hit the stops in both directions, collect up the contracts, and then trap another fresh batch of traders the other way. The M and Ws form at these levels. Okay? There are 3 levels of correction or rise over 3 days. Could it be 2.5 days? Yes. There are also 3 levels intraday. The 3 bursts. If you know where you are in the cycle, it's easy to pick your directional bias and take your trades. The first level of the correction in this example is driven by the market maker. You will see the fast moves on light volume. You can't tell volume, by the way. You just know by the move. The guys that trade the breakouts with Craig and understand this stuff, think for a minute. Even if you haven't traded with Craig, just think for a minute. Open your mind for a second. Ever seen a candle spike really fast? In a textbook, that is written as momentum. But what's really going on is the market maker is flashing the pair with as little money as humanly possible to get it to move or spike. And other times you've seen the breakout slow and steady, a smooth run. The slow and steady move is the real directional move by the market maker. So the first level correction is created with a flash into a pair. He might do it on a cross, he might do it with the cross, whatever, to save money. I'll talk about that. The second level of the correction is market driven in absence of the market maker. Why? He wants to see where the retail traders will push it. So what happens is this. He creates a stop hunt high spike, pulls back, hits the second leg again, starts the direction, and steps aside. He wants to see what the traders will do going into level 2. Will they buy? Will they sell? How will they set the straddle? How will the contracts or the money be set up? The third level of the correction, when you get to level 3, is again picked up by the market maker. He puts the brakes on, says that's far enough today. He'll trigger the stops again, make the push, validate the ABCD lightning bolt, and create more panic in the market. So understand, level 1 and level 3, since they are driven by the market maker, will be more aggressive. Those are the moves that have been scaring you out of good trades because you didn't understand that he was doing it to you. During the levels, market makers will buy from the traders to create their positions, with the heaviest volume being seen at level 3. At level 3, they're all in. They got to reverse and collect their equity back. Understand? When the signal appears simply buy or sell third level rises and third level corrections against the retail traders, lights out. If you can count to 3, profit will be realized in these trades. It's a joke oversimplification. Okay? Is there sound issues? No? Okay, cool. Okay, now, this is going to piss you off. It should. In addition to each of the 3 levels, there is a corresponding level of consolidation. Level 1 consolidation. Level 2 consolidation. Most of the time, when this is going on, the stops are triggered in both directions before the next